Every April, you stare at your paycheck and watch a huge chunk vanish before you ever touch it. Now imagine paying a lower tax rate than your own house cleaner. Some of the richest people on earth do exactly that, and almost none of it is illegal. There is no secret vault and no shady offshore island required. By the end of this, you will understand the real machine, not the conspiracy version, and you will see which of these moves you can actually use yourself. Let's start with the proof, because it sounds made up until you see the numbers. From 2014 to 2018, a study found the wealthiest Americans paid a true tax rate of around 8%. 8%. Meanwhile, a typical worker on a salary can hand over 22 to 37% on the top slice of their income. Here is the single idea that unlocks everything. You are taxed on income, they are taxed on what they sell, and owning is not selling. When you earn a wage, the tax is taken automatically before the money even reaches your bank. You never get a chance to play with the timing. But the wealthy rarely live on a wage. Their real money sits inside things they own: company shares, real estate, and entire businesses. And here is the quiet rule that changes the whole game. An asset that simply goes up in value is not taxed until the day you sell it. A founder whose shares jump by $1 billion on paper owes exactly zero on that gain, as long as they never sell. On paper, they got richer. On the tax form, nothing happened. So the obvious question becomes, how do you spend money you never sell? If selling triggers tax, how do they actually live? The answer is a strategy so clean, it has a nickname: buy, borrow, die. 3 steps that legally turn fortune into cash with almost no tax. Step 1 is buy. You acquire assets that grow over time: stocks, property, and ownership in companies that compound quietly in the background. Step 2 is borrow. Instead of selling those assets and paying tax, you walk into a bank and borrow against them as collateral. This is the part that feels almost magical. A loan is not income, so the cash you borrow against your stocks arrives completely tax-free. And because the wealthy are seen as ultra-safe borrowers, these loans can carry interest rates far lower than the tax they would have paid by selling. So they get spending money, they keep their assets, and those assets keep growing while the loan sits quietly underneath. The fortune never shrinks. Then comes the final step, the one that sounds dark but is pure tax planning: die. And this is where the biggest loophole of all opens up. Normally, if you bought a stock at $10 and it grew to $1,000, your heirs would owe tax on that $990 gain, but they usually do not, because of a rule called step-up basis. When you inherit an asset, its tax starting point resets to its value on the day you receive it. The old gain simply disappears. Decades of growth that was never taxed once gets wiped clean at death. The heirs can sell the next day and owe almost nothing on a lifetime of gains. Now, even when the rich do sell, the system is gentler on them than it is on you. This is the gap between capital gains and ordinary income. The money you earn from working is ordinary income, taxed at the highest rates. But profit from selling an asset you held over a year is a long-term capital gain. And long-term capital gains are taxed far more gently, with a top rate around 20% instead of 37%. The system literally pays you more to own than to work. There is even a special version of this for the people who manage other people's money. It is called carried interest, and it is one of the strangest rules in the entire code. Private equity and hedge fund managers take a cut of the profits they make for investors, often around 20%. For most people, that pay would be ordinary income, but the carried interest rule lets them treat that pay as a capital gain instead of a wage, taxed at the lower rate. They get paid like workers but taxed like owners. Next, let's talk about businesses, because owning one rewrites the rules of money completely. As an employee, you earn, get taxed, and then spend what is left. A business owner flips that order. They earn, then spend on real business costs, and only get taxed on the profit that is left over after all of it. Those business costs are called deductions. The travel, the equipment, the office, the meals with clients, each legitimate expense lowers the income that ever gets taxed. This is not a loophole. It is the basic logic of taxing profit instead of revenue. But the wealthy simply have far more of their life that can legitimately count as a business cost. Then there is the strangest deduction of all, the one for losses that are not really losses. It is called depreciation. When you own a building or equipment, the tax code lets you deduct a slice of its value every year as if it is wearing out, even while its real market price climbs. So a real estate owner can collect rent, watch the property appreciate, and still report a paper loss that wipes out the tax on that rent. Wheel cash in, taxable income gone. Stack enough of these on enough properties, and you can earn millions in real life while looking nearly broke on the tax return. The asset feeds you while showing a loss. Now for the part everyone imagines first: offshore accounts and holding companies. The reality is less James Bond and more boring paperwork. A holding company is simply a company that owns other companies and assets. It lets the wealthy organize their fortune to control exactly when and where profits appear. Some countries deliberately charge very low or zero corporate tax to attract this money, so profits get routed to where the tax bill is smallest, all on paper. Done legally, this is called tax avoidance, and it is allowed. Crossing the line into hiding money you legally owe tax on is tax evasion, and that is a crime. So step back and look at the whole machine. Notice that every single move rewards one thing above all else: owning assets instead of earning wages. The tax code treats a paycheck as the thing to tax hardest and treats owning things as the thing to protect and reward. That is the entire secret in one sentence. Which raises the real question: if the rich pay so little, who actually funds the roads, the schools, and the hospitals? You already know the answer. The weight lands mostly on wage earners, the people whose tax is taken automatically before they ever see it. The middle quietly carries the structure. But here is where this stops being a complaint and starts being a cheat sheet. Because some of these exact moves are available to you, just at a smaller scale. You can shift from only earning to also owning. Buying index funds or shares means you tap into low capital gains rates and growth that is not taxed until you sell. You can use retirement accounts, your own legal tax shelters, where your money grows without yearly tax dragging it down. The same delay the rich rely on, handed to you on purpose. And if you ever run a side business, you unlock real deductions, turning everyday costs into legitimate ways to lower what gets taxed. You start playing offense, not just defense. You may never reach 8%, but understanding the rules moves you from the side that only pays to the side that also plans. That is the entire shift. That is exactly what we do here. We hand you the cheat sheet to the money machine. This is Brainonomics.